Hey guys, Greg Silverman here, your alternative investment scout. There are pyramids of Giza behind me. Just going to read you some of the articles that were top of the hit parade last week. What you guys all liked, and an interesting one coming up on silver as well. But let's get to this one. This was actually the most popular one last week. Private equity giant Carlyle says vaccine won't prompt total bounce back. Predicts weaker dollar through 2021. Okay, that's an interesting, alternative view, I guess, by Eliza Haverstock on Forbes staff. The Carlyle Group has a message for the anxious investors. Don't fret about the Federal Reserve raising interest rates just yet. Even as the markets fare better than the Federal Reserve anticipated when it slashed rates to near zero at the outset of the pandemic and promised to keep them there as long as necessary, a sudden policy reversal isn't likely, according to the latest report out of the Washington, D.C.-based private equity giants with approximately $230 billion in assets under management. Sudden policy reversal isn't likely. Let's highlight that for the notes, and let's get the heading for the notes. Private equity giant Carlyle says vaccine won't prompt total bounce back. Okay, weaker dollar. Jerome Powell. Concerns about a change in Fed policy are reasonable, but where they're likely to manifest themselves is in the exchange rate as opposed to higher inflation or higher interest rates, says Jason Thomas, Carlyle's head of global research and author of the paper. The prospect of the Fed keeping real interest rates in negative territory, coupled with an increase in borrowing from abroad to cover larger fiscal deficits, leaves the US dollar as an obvious loser. That's well written. The prospect of the Fed keeping real interest rates in negative territory, coupled with an increase in borrowing from abroad to cover large fiscal deficits, leave the US dollar as an obvious loser. Engineering a minus 15% to minus 20% decline in the dollar through greater fiscal monetary coordination would be the perfect way to create space for more rapid domestic wage gains, especially in a world where inflation pass-through is limited by the dollar's dominant international role, spells out the report. For investors, foreign assets will appear more attractive. So too will U.S. businesses that derive a major share of their revenue and earnings from abroad when the financials are adjusted for the exchange rate, Thomas adds. So time to go international. Beyond matters of monetary policy, the report points out that demographic shifts, sector performance, and economic relations with China will help set asset prices in 2021. It's not just the vaccination, but then what does the vaccination do in terms of behavior and spending patterns? Thomas says, do behavior and spending patterns just automatically revert back to 2019 or what we think of as this normal? So it's not just the vaccination, but then what does the vaccination do in terms of behavior and spending patterns? Well, we love the behavioral stuff. Though most overall earnings estimates for this year are based on a return to normal, reality may be less clear-cut, and that presents a significant risk for investors. Asset prices are essentially priced to the best-case scenario, Thomas says. In sector terms, the report asserts that a rising post-vaccine tide is likely to lift all boats. For example, Carlyle found that analysts now expect cumulative subscriber growth projections for streaming service Disney Plus to be 4 times their predictions from 2019. While these projections may come to fruition, they are not likely to coexist with the 4 times to 6 times rebound in spending at theaters, sports venues, and live events applied by bottom-up earnings per share estimates, Thomas adds. An exodus from cities during the pandemic is also unlikely to reverse post-vaccine. Census data shows that U.S. home sales ended 2020 up 20%, from the year prior, indicative of a long-term commitment. The typical U.S. homeowner has been in their current residence for 13 years, according to 2013 data from the National Association of Home Builders. This accelerated shift from cities to suburbs could force some employers to embrace remote work after the pandemic subsides. which is also creating distress in the office market per the private equity firm. So it's got accelerating shift from suburbs could force creating distress in the office market. Finally, Carlyle expects China's economy to come out strong this year, following its effective response to COVID-19 and subsequent rebound in retail sales in late 2020. By Carlyle's calculation, global GDP likely contracted by -4% last year, while China expanded by 3%, and its economy is about 20% larger than that of the US. Wow. China's expanding. Okay, but I don't know how friendly capital is. Like private equity rival KKR, Carlyle says that investors who want exposure to China's massive economy must buy stakes in Chinese businesses with domestic demand. That advice is especially relevant for sectors under increased scrutiny by the US government, like software and tech. However, Carlyle doesn't see China's overall role in the global manufacturing chain diminishing given its unmatched infrastructure advantages, including 7 of the world's 10 busiest container ports. Let's put this all in because we know that shipping prices have really been increasing. Thomas expects an easing of tension to US and China under the incoming Biden administration, in contrast to KKR's belief that deteriorating relations between the two superpowers could present a black swan risk in the new year. China is the key node in the global manufacturing system, Thomas says. If you're going to confront China, it can't be in this area. Well, thanks for joining me. I hope you learned something. That was a very interesting article.